So I'm going to go ahead and call the meeting to order. I'm Heather Clayball, the Associate Superintendent of Fiscal Services. And as you know from the December meeting, I have taken over for Leslie Pellegrino, who has retired and is now working in some other organizations. She couldn't stay retired for long. So to begin the meeting this morning, we'll have the review of the minutes.
I motion to approve the minutes from Friday, November 17, 2023.
I'll second.
Okay, so we have a motion by Derek Hoover Beats and a second by Brian Roop. All in favor?
Aye.
Aye.
Thank you. So we'll get started with our guests from Siegel, Marco, Christian, and Tanya, if you'd like to begin with a review.
Okay. Good morning, everybody. Can you hear me? Okay,
Yes.
Great. Perfect. I'm going to share my screen. So we'll start with we have a couple of items on the agenda today. We'll start with the fourth quarter report, give you a current snapshot of where we are today in terms of the market values for the plan. We'll reopen the discussion on the private credit allocation and the manager who we met with last quarter, and then talk through a potential other new asset class called multi-asset class solutions. So I'll start with the fourth quarter report and just give you an overview of market performance for the fourth quarter. We ended the year on a very high note, I would say. So the bars on the bottom of this chart, the bar chart, the blue bars represent the month of December on its own, and then the yellow bars represent the full calendar year 2023. So you can see very strong month of December. Essentially all asset classes were positive. Very strong end to the year, led by U.S. equities all the way over on the left, with the S&P 500 up over 26% for the year. International equities, small cap and mid cap equities, as well as emerging market equities, also all in positive and in double digit or near double digit territory for 2023. On the fixed income side, we also ended the year in positive territory. The aggregate index, which is where we track our bond portfolios, to up 5.5% for the year, and treasuries and up 4%, and even global bonds and high yield up even more than that. So one area that we saw negative performance in was commodities. We don't have any direct exposure to that asset class in the plan at this point. Just taking kind of a deeper dive into the phenomenons within the U.S. equity market specifically, you can see over here, if we look at the sector returns for the year, communication services up 56% and information technology up almost 58%. Those growth-oriented sectors really led the way. And if you have read anything about the stock market in 2023, you've probably heard the term Magnificent Seven, seven technology or technology-related stocks that drove the market performance. They were up to collectively over 70% for the year. The rest of the other 493 didn't do bad. They were up 11%, but those seven stocks really lifted the performance of the markets overall. So overall, the S&P, as I said, up 26, the Russell 1000 growth, which all of those stocks fall in, up 43, and the value index up 11%. We are indexed to the core benchmark, and so we have exposure to all areas within the U.S. equity market, growth, value, and large cap, mid cap, as well as small cap. So we have kind of exposure to the full array of U.S. equities. On the international side, as I mentioned, also a very strong year, up about 18%. Emerging markets up about 10%. And then on the fixed income side, Fed policy is always kind of the hot topic and what they're going to do. They've held rates steady now for the last few months. And, initially at the end of 23, there was a lot of optimism that the Fed might start cutting rates in the early part of 24, and that drove a lot of the stock market performance at the end of the year. We've since, experts and a lot of economists have kind of tapered that expectation based on what the Fed has said. We don't expect that there will be any rate cuts, at least in the first half of 2024, potentially later on, during July or into the fall. In terms of Treasury yields, the brown bar at the top here represents where we were at the end of the third quarter, and then the green bar represents the end of the fourth quarter. So yields basically, other than cash, have come down everywhere. So if you're holding a 2-year bond, 3-year bond, 10-year bond, or 30-year bond, those yields came down during the quarter. But with that, we saw positive returns in the bond market. Oh, I went backwards. Let me pause there and ask if there's questions on the markets before we talk about the plan performance. Okay, I don't see any. We have an executive summary kind of written up here, and this just highlights some of the points that we'll talk about while we move through the report. So this is our current asset allocation policy that we've been operating under. We did, I would actually say this is our former asset allocation policy. We're working towards moving to the new asset allocation policy that we adopted last year. So we're still tracking this in our performance report, as we have not made any new investments into any other asset classes just yet. We are, in relation to this policy, as well as actually in relation to your new policy, we are within your guidelines. We are essentially at our fixed income target. The new target is actually 32.5%, and we're at 31.5%, so we're well within that range. Your equity target on the new plan is the new policy, is 40%. So even at 53.5%, we're still within the allowable range, but we are going to be looking to bring that down, and that's why we're going to talk about some additional potential new asset classes, as I said, later on in the meeting. So no concerns here at this point. We did rebalance. We made a decision to rebalance at the end of, or at the last meeting, So we did that during the quarter, and then I'll show you kind of what that looked like in dollar terms a little bit further in the report. So just on a cash basis, the quarter we started at 160 million, had investment earnings of about 17 million, so ended at 177 million in terms of a rate of return for the quarter. That was 10.5%. You can see the calendar 1-year return up 19%, so very strong, and that was driven, primarily by that large percentage in U.S. equities. On a 3-year basis, the plan has grown nearly $30 million with a combination of $8 million in cash flows and about $21 million in investment earnings. So the performance of the plan, and please stop me at any point with questions. I feel like I'm moving through this a little quickly, but I want to hit the points. But if you have questions at any point, please don't hesitate to interrupt. The performance of the plan, as I said, is up 10.5% for the quarter, up 19% for the 1 year. Both of those outperforming your policy benchmark slightly. And the reasons for that, the primary reasons for that has been the strong performance of your fixed income managers. You can see here, up 7.5% for the year versus the aggregate index of 5.5%. Both of your managers, Dodge and Cox on the core side, and Western Asset, which is a core plus manager, have outperformed the benchmark for the calendar year. I'll go back to U.S. equity. As I said, we consolidated that portfolio earlier in the year from a large cap and a small mid cap, 2 separate portfolios into one, kind of all total U.S. stock market index there. So we have about 7 months of history so far. For the quarter, up 12.2%. We talked about fixed income, international equity, your manager, American funds. For the quarter, really strong quarter, up 10%, and then the 1 year up about 16%, both of those outperforming the benchmark. I talked about fixed income, and then we have a very small percentage in cash down here at the bottom. And for the first half of your fiscal year, the plan is up 6.5%. I will touch on a couple of other pages. We have calendar year history here, tracking that, and then we also have all of your historical fiscal years as well. This is how your plan compares to other public defined benefit plans, so other OPEB and other pension plans within the public space. You can see these rankings next to the returns show how you do versus peers within the universe. So the higher the number, generally the better. So a ranking of 1 on the calendar year means you've done better than 99% of other similar plans. Similarly, over the 10-year basis, a ranking of 4 means you've done better than 96% of the plans. So very strong numbers. I would say, a lot of that has been driven by the heavy weighting in equity, which is something we've talked about kind of bringing down, because while it's helped significantly from a return perspective, it also comes with additional risk in the markets. Just jumping ahead here to the fee pages. Overall, investment management fees on assets total average to 21 basis points, very reasonable compared to some other plans that we have. And a lot of that is due to the large percentage in an index fund on the US equity side, which is, you can see, is a very low fee. I think it's actually 1.5 basis points, but we round to 2 decimal points here. And then lastly, just looking at kind of cash flow and asset growth, where we ended 2020 and where we are today, strong growth there. You can see the numbers have actually kind of flip-flopped. So 21 was a very strong year. 2022, of course, very tough year in the market. So we kind of ended back up where we were in 2020. And then now we're today, as of the end of 23, we're back up to where we were 2 years ago. So we've earned back everything, that was lost in 22, given the very unusual market conditions that we saw last year. Then for this quarter, as I said, we did rebalance. So this page, you can see here, we took $5 million from the equity fund and rebalanced it to Dowd & Cox fixed income. So now we are back closer to targets within the investment policy. And that is all I have on the performance report. So I'll pause for questions. Okay, I don't see any. I will bring you up to date where we are as of 2 days ago. So February assets, February 21st, up to 180 million. So growth of about 3.5 million from the end of December. And if calculating that into a rate of return so far this year, up about 2%. So strong growth. We've seen strong growth in the equity market so far this year. We've seen a bit of a pullback in fixed income as rates have started to rise again. But overall asset value is continuing to grow. And just one other comment going back to the report. Actually, we do still have one manager on watch list. We put Western Asset on watch list in September of 2022. They've had a very strong calendar year this year, as I said, up 6.8 versus the benchmark up 5.5. But we thought coming off of their year last year in 2022, where they were down about 19, it makes sense to just keep them on watch and see how they continue to perform throughout 2024.
I'll just add that one of the items we have on the roadmap for later in the year is revisiting the structure of the fixed income portfolio. So we'll take a look at how those two strategies, Dowd & Cox and Western, coexist, the diversification benefits of having them both, but also potentially looking to further diversify that bucket.
Thanks, Christian. Okay, if there's no other questions here, I guess we can move on to the private credit discussion. You'll recall 2 meetings ago, we did a full kind of introduction to private credit, the asset class itself. And then last meeting, we had a potential manager, Hamilton Lane, come in and present their strategy. And so what we have done here is we've taken the market values of the plan, how it's grown through 2023, and updated this page, which was in our original private credit market overview. and to look at basically what it would take to get the plan to the 7.5% target that's in your investment policy statement. And so what the study has shown us is that given the modeling, we suggest committing around $8.5 million in each of this year, 2024, 2026, and 2028, with potentially additional commitments thereafter. This is, of course, all kind of a current snapshot in time. So what we would recommend is committing $8.5 million in 2024. And then, of course, when the time comes in 2026 to make another commitment, we will update the study and change that number for the next fund that we would look to go into at that point, if needed. And just as kind of a reminder for how private credit and how private markets in general work, we recommend committing $8.5 million, and because that would help us get to that target over time. But they don't call the money immediately, so we don't just send them $8.5 million on day one. They'll call that slowly over a period of about a year. And then we will, revisit that again in a couple of years. So let me pause there, see if there's questions, and specifically to the pacing, or specifically to Hamilton Lane, who's the manager that came and presented last quarter.
Tanya, I have a question for, I think, both you and potentially Heather. And Heather, sorry to
Sure.
put you on the spot on your first meeting, but I was just curious, funding the 8.5, and I understand how the capital call process works,
Sure.
but is this most likely going to get funded through another asset class? Was it equity we were reallocating? Or
Yes. We would reallocate within equity.
And
From equity. Yes. Great question.
And then Heather, to you, what is our budgeted contributions for the year? I'm just curious because usually we push contribution towards whatever's underweight. So I didn't know if we would use contributions to help fund this as well or not, or if it would go somewhere else.
So unfortunately, in FY24, there is no budgeted contribution. But the board did give us parameters that as we were assessing our fund balance towards the end of the year in our category 12, which is where this contribution usually sits, and had fund balance available, that I could make the decision to move up to the $2.5 million to the fund, to the OPEB trust. So at this point, it's very early in the year in regards to our fund balance. We meet after, right now we're meeting monthly, but in April we meet after every payroll. And category 12 is also where all of our fringe benefit sits, as well as our FICA and other workers' comp, all of our benefits, essentially all of our fringes. And so as we're assessing what's available, we'll be making that decision. And hopefully, because we meet again in May, by then we will have an assessment and be able to say if we're able to make the commitment to move the $2 million to up to $2.5 million over to the OPEB trust.
And you're a June 30 fiscal year end, so this would be kind of a May, June type thing.
Correct.
Got it. Okay. Thank you. Thanks, everyone.
So I think, Heather, we defer to you, but we would probably need formal approval to move forward and get the documents from Hamilton Lane and provide those for legal review and eventually execution.
So I think at this time we should, because it is part of our policy, we I double checked with Leslie just to make sure I had all the right information, because why not phone a friend when she's available? So she said, because I hadn't attended a lot of your meetings, that typically the committee does vote. And so I think at this time it would be appropriate, unless there are any additional questions regarding, and because it is a new class for us, the review process is going to take a little bit of time to make sure that we review all the legal documents. So we want to make sure that if we're going to move forward within the next couple months, that we have that time to do the review. So that's why want to make the commitment to move forward today. So at this time, if someone would like to make a motion. Don't all jump in at once.
So moved.
Thank you. And there's a second.
I second.
All in favor? Okay, so we will get the ball rolling with the private
Great.
credit.
Great. And just to give you an update, when we met with Hamilton Lane, they were in market for Fund 8. That fund closed at the end of 2023. So they will be opening Fund 29 at the Fund 29, excuse me, Fund 9 at the end of this month, at the end of February. And we will get, as soon as we can get the documents from them, probably within the next week, we will send those over to Heather. We expect that the first kind of opening, the first opportunity to get into the fund is in April. So, and they have what they're calling an early kind of closing discount through the end of May. So if we get in kind of by the end of May, there'll be a discount on the investment management fee. We don't want to put any additional pressure on the attorneys, but hopefully that gives them a little bit of onus to help us get in with it within the next 3 months. But if we miss it, we still can get in the fund this year. It just we would not have that discount.
Tanya, is it safe to say that legal docs are fairly standard and that they are the same for any potential investor, or is it unique to each investor?
That's a great question, right? Their documents will be unique to their fund, but they're the same documents they'll send out to all potential investors. But to Heather's point, documents for a private investment like this, sometimes look different than the traditional investment. So they could take a little bit of further legal review. All right. So with that, I will keep sharing, but I'm going to welcome in Christian, who's going to talk about our multi-asset class potential investment.
Thanks, Tanya. So this is intended to be partially educational, an introduction to the asset class, give you a sense of some different managers in the space. And then we're going to pivot the conversation a bit and just talk a bit more about the current environment and some thoughts Tanya and I have had more recently just about the asset class and sort of the fit here for the trust. So Tanya, if we go to page 3, and the first few slides here, again, think of it as somewhat of an educational session. This is a bit less complex in terms of what it is relative to a lot of the private investment and private credit topic that we worked through recently with you. Fundamentally, what we're talking about here is adding a new asset class that is entirely liquid assets. So think primarily stocks, bonds, like you already have in the portfolio, but consolidating them under one investment strategy. And then depending on the strategy, there could be some other asset classes like commodities or specifically currencies. All of these strategies have a global focus. So not just US centric, but really investing around the world. The real key here is that these strategies are trying to add diversification to your portfolio. And if you think about when these really got popular, in the very low interest rate world we had been in really until 2022, coming out of the financial crisis all the way back in 2008, a lot of plans were really struggling for sources of return because you had obviously stock markets that had been beaten up pretty badly and they did rebound quite strongly. But with interest rates as low as they were, you really couldn't get much return out of a lot of the other parts of the portfolio, primarily your bond allocation. We are going to speak sort of broadly about the asset class, but there are a lot of they're very idiosyncratic strategies in the way they're run. The managers go about this very differently. You can see we've listed for you 3 candidates at the bottom of the page: PIMCO All Asset, Graham Quant Macro, and Nordea Stable Return. The way they actually implement the strategy is quite different. But fundamentally, again, using these traditional and liquid asset classes These are not lockup vehicles, so they're intended to be the types of vehicles you can get money out of in a relatively short amount of time. So they are distinct from more private oriented strategies and lockup vehicles like the Hamilton Lane strategy. So if we go to the next page, there's a lot of lingo and buzzwords on this page. So I'll just highlight a few things for you. The first is the first bullet point that just talks again about the fact that these are strategies that utilize cross section of asset classes. They can be very customized depending on the vehicle in which they're run. The vehicles we're going to look at with you would be more in the commingled fund or mutual fund realm. So funds that are generally easy to access, again, have very high liquidity. And so they fit nicely in that more traditional part of the portfolio. And then if you look at the second bullet point, these are generally the types of strategies you might see in this space. And there's some overlap here in terms of, a manager can sort of take on multiple types of these strategies. So we can come back to this. I don't think it's as critical as the third bullet point, which talks again a bit more about the characteristics of these types of strategies. So being liquid, having transparency of holdings. So at the end of every month and certainly every quarter, you can see what the underlying holdings of the portfolio look like. Again, the emphasis on public and not privately traded instruments. Derivatives, so think futures, options, forwards. These are all instruments to get market exposure without owning outright, say, stocks or bonds or commodities. So they're very common, and we could do an entire education session just on derivatives, but they are very common in the application of these strategies. And for the most part, these are not derivatives meant to add risk to the portfolio. They tend to be used more as a means of getting exposure to certain asset classes and also providing hedging and short positions. So taking some of the market risk out of the portfolio. I think one of the important things to understand here is the second sub-bullet point under the Max Manager main bullet point, which is that benchmarking in this space is very difficult. And that's, again, a function of the fact that these managers have their own strategies and go about things differently. But also, anytime you start bringing in multiple asset classes, it can be very challenging to find a good benchmark to measure those against. As I said, they are liquid strategies, so there are no lockups. The fee structures tend to be pretty standard for public investment strategies, and you'll see that in just a minute on another page that'll show you. And then I mentioned that there are different types of vehicles, and the ones we would focus on in the space, especially for a plan like yours and given your size, would be more of the collective structure or mutual fund relative to a separate account where you really need a lot of scale to build that account. Bottom left, I think, is a good sort of representation of common types of asset classes that you see in these strategies. So, of course, equities globally, and you see different subtypes, US, international, emerging markets, and REITs, which are real estate investment trusts. So think of that as primarily tradable real estate funds or real estate securities. Fixed income, again, globally, and you see the different sub-asset classes listed there. And then I already mentioned currencies and commodities. The box to the right on the bottom, I think, speaks generally more to types of strategies within each of these. So I mentioned different types of derivatives. You see those listed there, forwards, futures. But then you get into things like alpha overlay, market neutral. I think for the purpose of this introductory conversation, we won't go too deep there, but every manager has their specialization, and I've said now a few times that they go about things differently. But the ultimate goal here, again, is to generate positive returns in excess of rates of cash and commonly rates of cash plus some additional amount above that. But doing that in a diversified way so that when you put this into a portfolio, it doesn't perfectly correlate to what is already there. In other words, if one thing's going up, it's not necessarily a bad thing to have something else not keeping up or not going up as much or even going in the other direction, as long as you get protection in more challenging markets. I'm going to go a few more pages ahead Tanya, to page 9 and just give you a bit more of a sense on the next 2 pages in terms of these managers. So the first manager is PIMCO All Asset. They do run this strategy in a mutual fund. There is a advisor that sits over top of this strategy called Research Affiliates, and you can think of them as a professional asset allocator. And what they do is they utilize PIMCO, who's a money manager specializing in fixed income, but really across all markets. They, based on their asset allocation forecast, they'll invest in underlying PIMCO funds. So this is what we would refer to as a traditional global tactical asset allocator. If you look at the performance expectation section, CPI plus 5 is their target return. CPI is representative of inflation. So over a long period of time, what this fund is trying to do is outperform inflation plus 5%. And then you can see the line below that, the target volatility is 9%. If you think about stocks and bonds and what volatility, so when we say volatility, we're talking about standard deviation. So for those of you, and I know there are a few in the room that are more math inclined, standard deviation is a very basic measure of risk. When we talk about investing, a 9% volatility or standard deviation, that falls somewhere between stocks and bonds historically. So that's not surprising because a lot of times these strategies, what they're trying to achieve is a return and a risk profile that will fall somewhere between the two, stocks and bonds. But again, giving that additional diversification to the portfolio. So this is a pretty straightforward strategy. It's one that we've had a lot of utilization with in client accounts over the years. And I'll show you the fees on that in a minute. But you can see the other characteristics there. The redemption terms, because it's a mutual fund, it trades daily. You know, that is attractive for a lot of clients that want a more liquid strategy in their portfolio. I would contrast PIMCO to the other two on the page, and the biggest difference is both Graham, especially Graham, but also Nordea, take more of a quantitative approach to their investing. And so Graham is what we refer to as a quant macro hedge fund. They are running this particular strategy in a more liquid vehicle. So it's not it doesn't have the characteristics of a more private oriented hedge fund that you typically see. But fundamentally, Graham is a hedge fund manager. They have proprietary models, again, very quantitative in nature, as opposed to PIMCO that's doing things on a more fundamental basis. There's a bit less transparency here in terms of the process. Ultimately, you can still see the exposures of the fund on a rather regular basis, at least quarterly, in some cases monthly. But the way they get there and the different trading techniques that they're using, a bit more black box in terms of the procedure that they take. So they've been very successful in managing low correlated portfolios, providing diversification. You can see the target volatility is about 10%, so pretty consistent with PIMCO. They don't give a stated target return, but importantly, they do also offer a mutual fund that has a slightly lower risk profile. It's about 8% target volatility. Nordea is a bit more similar to Graham. It's a manager that has more recently become rated recommended, and I should have noted that all three of these strategies are rated recommended by our research team. So it's a bit newer on the scene for us. You can see the return bogey is a bit lower, so cash plus 4%. And the target volatility, again, falls somewhere between that bond and stock range, a bit closer to bonds. So it's a bit less volatile probably than the other two would be over time. The next few pages, I'm just going to give you a sense again of the different asset classes. So PIMCO, this is a gross oversimplification on page 11. Oh, I'm sorry, Tanya, I skipped the fee page. Why don't I go to 10? So the fees, I think this is the first thing to really highlight, and we're going to turn this conversation on its head in just a minute. But if you look at the fees here, you're certainly paying a lot more for these strategies than you do for what's in the portfolio. And Tanya just showed you that. You have a very low fee investment program overall. This would certainly be a departure from that. The fees for these managers are not inconsistent with what we see in the space. Anytime you're mixing in multi-asset class managers and strategies that are very unique and complicated and require large investment in systems and people to run, you're going to see higher fees. So PIMCO overall, if you look at the management fee column, is just under 90 basis points. That's about as good a deal as you're finding the space, generally speaking. And Graham and Nordea, just given that those are even more complicated strategies and greater reliance on systems and quantitative approaches, you see that the fees are more. MF stands for mutual fund, so that would be more consistent with the PIMCO style of vehicle, whereas CF under Graham stands for commingled fund. There are two different classes there for Graham, so you can invest in one that just has a mutual fund, just a management fee, but no performance aspect, and the class A has both. So think of the performance fee as an additional fee that would be paid based on the manager's level of performance. One more thing to show you on pages 11, 12, and 13 are the exposures. So we break PIMCO into three basic parts. You have equities, bonds, and diversifiers. Diversifiers is a very broad category. So that would include things like emerging market debt and equities. It would include real estate. It would include commodities. This just gives you a sense. I think the biggest takeaway that you should have from this page is just that these allocations vary pretty considerably over time. And again, this is based on the research affiliates, the asset allocators' perspective on where value is in the market. Similarly, on page 12 for Graham and page 13 for Nordea, Graham has currencies and commodities in their portfolio. Nordea does not. That's the biggest difference there. But again, you see for the two that they do vary their allocations over time. And again, that's what you're paying the additional dollars for. So I think the things here that I want to highlight before we pivot the conversation a bit. One, these are higher fee strategies. Two, they are much more complex. And I don't think that I'd say transparency is the problem, but there is more of a proprietary sort of approach to the investing method, and that can be less clear to someone like you, who's the ultimate investor in these funds. So those are key considerations. Before I move forward in the conversation and just give you some thoughts that Tanya and I have, are there any questions generally on the asset class? I know we could certainly go a lot more deeper on the managers, but I think what we want to sort of talk about next is pretty important in terms of moving forward. Okay. So I think, importantly, why are we talking to you about this asset class today? Going all the way back to the RFP, this was an asset class that we included in a hypothetical asset allocation for your consideration. And that goes back to early 2023. And when we did our roadmap for 2023 and 2024, we also included the max asset class. As I pointed out, historically, given the very low interest rate environment we were in, these strategies actually, we think, served a pretty useful purpose. We saw pretty widespread utilization of them. I think another way to think about this asset class is it's a way of getting hedge fund-like strategies, but without necessarily investing in classic hedge funds. Again, I mentioned Graham is, fundamentally they're a hedge fund manager. They're running a very similar strategy in what we would term a multi-asset class vehicle. So when we did the RFP, and even last year, we were in the environment where inflation was very high. The Federal Reserve was raising interest rates, and they were doing that very aggressively. And if you think about the experience that we saw in the traditional markets, the equity market in 2022 was down 18%. The bond market, the bigger surprise, was down 13%. So you didn't have the benefit that you had historically, where bonds were providing diversification to stocks. That has changed, and that's changed dramatically. So the environment we're in now, and part of the reason you saw such strong performance in the fourth quarter, is that now the narrative has really shifted from the Fed being super concerned about inflation and having to raise rates to, well, how soon is the Fed going to start cutting rates? Meanwhile, because we've experienced this pain in bonds as yields have risen, you're now in an environment where investing in bonds is much more attractive. You get paid, yields around 5% now for investing in bonds, whereas the exact same strategies a year and a half ago, you were getting paid around 2%, in some cases below that. So we think that that is the biggest change that's occurred, during this period between the RFP and now. And we've already taken advantage of the higher bond yields by as Tanya mentioned, rebalancing some money out of equities to bonds. But ultimately, given the higher bond yields coupled with the fact that inflation is lower, and a lot of times these multi-asset class mandates, PIMCO is a great example, they're designed to offer some protection against inflation. We're not saying we're all the way there or the Fed is all the way there in terms of combating inflation, but it's much less of a risk today than it was 12 and 16 months ago. So if you take those two key factors, the higher interest rate environment, the better opportunity in bonds, the fact that inflation is less of a risk, and then you couple that with the higher fees you'd be paying in the MAX space, and some of the transparency issues or benchmarking challenges there. Ultimately, where Tanya and I come out on this is we don't think this is the best opportunity right now. We don't think that it's as attractive an opportunity. We think that the fee consciousness that you've demonstrated so far continues to make sense. And because the next step for us is to review with you the fixed income structure, and there could be some additional opportunities there, we think it makes more sense going forward to emphasize that part of the portfolio. Put this off to the side. Obviously, we could enter an environment that's dramatically different from today, a year or 2 years from now, where maybe interest rates are back down pretty significantly, and these types of strategies could make more sense. But just given the opportunity out there today and all those other things I just mentioned, we think the best course of action for you is just to put this off to the side. I think importantly, we want to mention that when we built your investment policy statement with you, we made sure there was flexibility in this allocation. So this is in no way forced for you. You don't have to make this allocation. We have a 0% lower range. Tanya just pulled that up. You can see that under MAX. The range we have is 0 to 15%. We did establish a target of 10%, but the whole purpose there, as we did with private credit, was just to give you some flexibility around the allocation. So I've been talking for a while. I know that's a lot of information. Why don't I pause and just see if there are any questions? Generally, it could be about the asset class and the education aspect. It could be about the managers, or it could be about our view on the asset class at this point in time.
Christian, one question for me. I assume this is going to help diversify the portfolio, obviously. Like, what kind of correlation is there to like the overall markets? Like, can you just walk through how it'll help diversify the portfolio and what it'll do to potential risk-adjusted returns?
Yeah, I mean, we do have a slide. Tanya, if you go to 25.
Okay.
So this is a correlation table. You see the three managers on the top. In the left column, you see the different benchmarks that represent the equity and bond market. The Russell 1000 represents large cap stocks in the US. Russell 2000 is small cap stocks. The MSCI ACWI US is international markets. Bloomberg US aggregate, that's that core US benchmark. And then the global aggregate is obviously global bonds. So we measure these going back to the inception of the strategies. And in terms of what the numbers mean, if you saw a number of 1, it would mean that the investment is perfectly correlated to the asset classes on the left. That means they move in tandem. If you see a number that would be -1, and of course we don't see these extremes here, but it just gives you the sense of the scale. A -1 would mean the asset class moves completely opposite to the fund, or the fund moves completely opposite to the asset class. So essentially, from a diversification standpoint, the lower the number, the better, because it means you're getting more diversification. It's not surprising to see the distinction, for instance, between PIMCO and Graham, given that PIMCO is more of a long-only manager, meaning they're not as focused on taking short positions in different markets. They have historically had a higher correlation to both the traditional stock and bond market. Graham, being a quant and global macro hedge fund manager, their entire emphasis is on diversification. You probably noted when we looked at the return objectives that they didn't even give a return objective. They were more focused on the risk aspect of the strategy. That worked exceptionally well in 2022 when we had those challenging markets, but they were the worst performer of the group last year when we had both improving stock and bond markets. So there is a trade-off there for that diversification. Needless to say, these would all add some benefit from a diversification standpoint. I think the bigger question, Brian, from us is, are you getting the benefit from a return standpoint? If you look at the risk adjusted returns that you're getting based on the current environment, does it make sense to use your your fee budget on these types of strategies relative to stocks and bonds? And where Tanya came out and I come out is just at this moment in time, the answer is no, because you're getting paid so well on bonds. I think also we talked about it a bit, how strong the market has been, but it does seem that there are some tailwinds still for this equity market. It's very difficult to forecast in the short term. But if you think about, all this development on the AI front, the fact that, a company like NVIDIA, who's had an incredibly strong run on a price to earnings basis, their multiple keeps coming down, even though their stock is up about 300% in the last 16 months. So that's a pretty extreme example. We've never seen a stock move in terms of market cap the way that particular one has. But if you couple the strong momentum we've had in the equity market, with the more favorable interest rate environment, the fact that inflation is coming down, this is I think, much more compelling market globally that we're in today than it was early in 2022 when we were facing what we knew were going to be pretty significant rate hikes.
Got it. Much appreciated.
Sure. Thanks for the question. So we just to summarize, we thought it was important to give you a sense of the asset class. We didn't want to just not address it because, we've talked about it with you and we've had it in your roadmap. But I think this is an example of just and a reflection of how the environment has changed and us wanting to help you take advantage of what's out there, but also keeping this emphasis on your costs and making sure that we are thinking about things clearly in terms of the environment. So there's an opportunity today in bonds that hasn't been there, and that continues to be what we want to try to take advantage of.
So are there any other questions from the group regarding this asset class? So I think at this time, given I believe next meeting we're going to talk about the fixed assets. It might be wise to table this, and I think I appreciate the flexibility that's been built into our investment policy to allow us to review different assets classes without having to make a commitment to them, but as things change, as we venture into 24-25, being able to come back to it if it makes better sense in the future. So let's see. Are there any? So give it one more time for any questions about anything we've heard today in regards to our update of the performance, the private credit, or this multi-asset class. It's a very quiet group today.
Hopefully we didn't put you all to sleep.
Not at all. It's very interesting, and I appreciate the level of detail that you provide, as well as the reports, having the opportunity to read them beforehand in case there are any things that pop up. I appreciate that.
Our pleasure. And if there are ever questions in between meetings, Tanya and I are always available to help you with those. So don't be shy.
Absolutely. Well, if there aren't any questions, that concludes our business for today. So I will adjourn the meeting, and Lynn, can you remind me of our next meeting?
Our next meeting is Friday, May 24th, in person at Central Office in Conference Room 5A.
Excellent. So we will see you all in May. Thank you.
Thank you, everyone.
Thanks, everyone.
Thank you,
Have a good
everybody.
day.